Dual reality shock. Western futures closed the week in familiar territory, prices elevated but orderly, volatility contained within historical norms. Yet while regulated exchanges went dark for the weekend, offshore venues and thin liquidity markets began printing dramatically higher levels in gold, silver, and oil. That contrast is the starting point. Official settlement says stability. Physical premiums and weekend trading say stress. The geopolitical escalation is the visible catalyst, but not necessarily the root cause. Extreme dark market prints demand verification, not belief. They demand analysis of structure. If physical silver is trading materially above futures benchmarks, one of two mechanisms must resolve the divergence. Futures must reprice higher, or physical premiums must compress. Both cannot persist indefinitely. This creates a dual system narrative. Paper liquidity versus physical scarcity, now amplified by an oil spike injecting inflationary and collateral stress into the equation. The real question is not whether prices moved, but whether the market is repricing risk or revealing plumbing strain. Immediate context and event breakdown. The sequence unfolded quickly. Geopolitical escalation intensified, followed by reports of disruption risk at a major energy choke point. War risk insurance premiums were repriced almost immediately, and crude oil responded with an aggressive move higher, trading roughly 8 to 10% above prior settlement levels in thin conditions. Energy markets remained partially active while major Western metals futures exchanges were closed, creating a fragmented price discovery environment. During that window, offshore and crypto-linked venues began printing elevated gold levels, with some transactions indicating prices materially above Friday's close. Silver followed, with weekend spot proxies and tokenized instruments trading sharply higher. At the same time, reports indicated widened Shanghai premiums and tighter physical bid conditions in parts of Asia. The divergence between Western paper benchmarks and Asian physical pricing expanded relative to prior weeks, when premiums had already been firm but contained. It is critical to clarify liquidity conditions. COMEX futures were closed. Most institutional participants were sidelined. Weekend order books are thinner, meaning smaller flows can generate exaggerated price swings. That does not invalidate the move, but it contextualizes it. In stress periods, risk premium repricing often occurs first in less constrained venues. Implied volatility in metals had already been expanding before the weekend, reflecting rising uncertainty. Now futures will reopen against a different macro backdrop: higher oil, elevated geopolitical tension, and visible physical premiums. This becomes a convergence problem. Either futures gap higher to meet physical pricing, physical premiums compress back toward paper benchmarks, or volatility expands sharply during reconciliation. The issue is not the headline move. The issue is whether structural pressure is building underneath, data stack and market plumbing. To determine whether this divergence is noise or structural stress, we move from headlines to inventory math. Silver futures trade in standardized contracts, each representing 5,000 ounces. Open interest reflects the total number of outstanding contracts. When you multiply open interest by contract size, you get the notional ounces theoretically standing behind paper exposure. That number routinely exceeds the amount of registered silver available for delivery. Registered inventory represents metal that is warrant-backed and immediately deliverable against futures contracts. Eligible inventory, by contrast, sits in exchange-approved vaults, but is not currently registered for delivery. It belongs to private holders who would have to convert it to registered status before it could satisfy a delivery claim. In calm markets, that distinction rarely matters. In stress periods, conversion rates become critical. Recent vault reports have shown fluctuations between eligible and registered categories, with periodic drawdowns in registered stocks during active delivery months. When delivery participation rises relative to prior cycles, it tightens the effective float. If open interest remains elevated into first notice day rather than rolling forward, the ratio of paper claims to deliverable ounces becomes more sensitive. Exchange for physical activity is another signal. An increase in EFP usage can indicate that participants are shifting exposure off exchange into OTC markets, often to source physical metal directly. That does not imply default risk, but it does suggest tighter arbitrage conditions. Spread behavior provides additional clarity. Silver typically trades in contango, meaning future months price slightly higher than near-term contracts due to storage and financing costs. If near-month contracts flip into backwardation, where spot trades above futures, it signals immediate demand pressure. Persistent backwardation in a monetary metal is rare and often associated with physical tightness rather than speculative enthusiasm. Volatility term structure also matters. When near-dated implied volatility rises faster than longer-dated options, it reflects short-term uncertainty concentrated around settlement windows. Margin adjustments from exchanges can dampen excessive leverage by raising capital requirements, often cooling speculative spikes. If open interest expands alongside rising prices, that suggests new longs entering the market. If open interest contracts while price rises, it may indicate short covering rather than fresh conviction. Lease rates, when elevated, signal tighter wholesale lending conditions in physical silver markets. That dynamic differs from a purely speculative futures rally driven by leveraged positioning. A leverage-driven spike tends to unwind quickly when margins rise. A physical drawdown-driven move persists as long as inventory remains constrained. Exchanges have enforcement tools, position limits, margin hikes, delivery rule clarifications, and in extreme scenarios, incentivized cash settlement. These mechanisms exist to maintain orderly markets, not to signal failure. Historically, markets fracture at plumbing stress points, inventory ratios, settlement mismatches, and liquidity gaps, not at the headline level. Silver's relatively small market size compared to gold amplifies these dynamics. Modest capital flows can materially impact spreads and inventory pressure. Ultimately, the ratio between open interest and registered stocks, combined with actual delivery participation, will determine whether elevated premiums resolve through higher prices or increase structural strain. Structural explanation layer market disconnects during stress cycles are not anomalies. They are structural features of segmented liquidity. Futures markets, OTC dealer networks, and physical retail channels operate under different constraints. Futures trade on margin with centralized clearing. OTC markets rely on bilateral credit lines. Physical retail depends on fabrication, logistics, and wholesale supply chains. Under normal conditions, arbitrage links these layers tightly. If futures trade below physical value, participants buy futures and sell physical, compressing the spread. That mechanism assumes smooth credit transmission, stable shipping lanes, and confidence in counterparty performance. In stress environments, those assumptions weaken. Credit risk rises, shipping delays extend settlement timelines, capital controls restrict flows, and risk aversion reduces balance sheet willingness to intermediate. Arbitrage becomes slower, more selective, and more expensive. Premiums widen not because markets have failed, but because friction has increased. We have seen versions of this before. In 2008, liquidity froze across credit markets even while core exchange mechanisms remained operational. In 2020, COVID-related refinery shutdowns created temporary dislocations between futures pricing and deliverable bars. Divergence did not signal systemic collapse. It signaled logistical constraint and funding stress. Energy shocks add another layer. When oil prices spike, inflation expectations adjust upward. Higher expected inflation increases hedging demand for monetary metals, particularly gold. Sovereign buying of gold over recent years has provided a steady bid beneath the market, reinforcing its reserve asset status. Silver, however, straddles two worlds. It functions as a monetary hedge, but also as an industrial input tied to solar, electronics, and electrification demand. That dual identity makes it more sensitive to both inflation expectations and growth uncertainty. It is important to avoid conspiratorial framing. Exchanges are designed to prioritize orderly settlement. When volatility rises, dealers widen spreads to compensate for inventory and funding risk. Margin requirements increase to restrain leverage. These adjustments can amplify short-term price swings, but they are mechanisms for restoring balance. Stress cycles are cyclical, not inherently apocalyptic. Price gaps are the market's method of reconciling mismatches between supply, demand, and liquidity. However, if elevated premiums and tight spreads persist into active delivery windows, the conversation shifts from temporary friction to structural strain, and that is where the next layer of analysis begins. Countdown, Josh, pressure. Window timing now becomes critical. The active silver contract approaches first notice day, the point at which long holders must decide whether to stand for delivery or roll forward. In normal conditions, the majority of speculative length exits before that deadline, shifting exposure into the next active month. That roll window is typically orderly and well telegraphed. What matters here is participation behavior. If open interest declines steadily into first notice day, it signals routine rollover activity. If a larger than usual percentage of longs hold through the deadline, delivery intentions rise, tightening near-term inventory dynamics. Settlement cycles and clearing deadlines then move from background mechanics to focal stress points. This is not about predicting outcomes. It is about observing reactions. Futures markets are reopening into a changed risk environment defined by higher oil, elevated volatility, and visible offshore premiums. The next few sessions will show whether spreads compress back into contango, vault reports reflect fresh inflows, and delivery notices remain consistent with prior months, or whether tightness intensifies. Short-term catalysts include oil stability or further expansion, volatility response in metals options, and any central bank commentary affecting dollar liquidity. Volatility often overshoots before stabilizing, particularly when liquidity returns after closure. This window functions as a diagnostic period. Structural stress either resolves quickly through price adjustment and rollover activity, or it compounds quietly into the next delivery cycle. Macro overlay. Beyond exchange mechanics, macro forces shape the magnitude and direction of any metal's repricing. The dollar index is often the first pressure valve in geopolitical stress. In many episodes, global capital seeks dollar liquidity, strengthening the currency even as uncertainty rises. A firmer dollar can suppress metals in nominal terms, particularly in futures markets, even when physical demand remains resilient. Oil's spike complicates that dynamic. Sustained higher energy prices feed into inflation expectations and influence real yields. If inflation expectations rise faster than nominal yields, real yields decline, typically supportive for gold. If nominal yields rise aggressively in response to inflation fears, the effect on metals becomes more mixed. Silver, with its industrial component, is sensitive to both inflation hedging flows and growth expectations. The Federal Reserve's posture remains central. A tightening bias aimed at containing inflation can restrain liquidity and pressure leverage positioning in commodities. A pause or pivot toward accommodation, especially amid geopolitical risk, would reduce headwinds for metals. Bond market reactions therefore become a critical signal. Sovereign gold accumulation has provided a structural bid in recent years, reinforcing gold's reserve status. Silver does not benefit directly from central bank buying, but it gains from industrial demand tied to electrification, solar deployment, and infrastructure spending. That dual exposure creates tension in inflation versus recession scenarios. If oil remains elevated, margin compression spreads across global growth channels, increasing macro instability. In such environments, safe haven flows intensify. Ultimately, macro forces either amplify existing plumbing stress or counterbalance it through tighter liquidity conditions, shaping the path metals take from here. Bull case. The disciplined upside case rests on persistence, not headlines. If physical premiums remain elevated after futures reopen, if open interest holds firm into delivery windows, and if vault reports show accelerating drawdowns rather than replenishment, the structure tightens. Add sustained oil strength reinforcing inflation expectations, and silver's dual identity begins to matter. Scarcity math is central. The silver market is small relative to global capital pools. Incremental allocation shifts from institutions, family offices, or sovereign-adjacent entities can move pricing disproportionately. Mine supply growth has been constrained in recent years, while industrial demand tied to electrification, solar expansion, and advanced electronics remains structurally resilient. In that environment, volatility itself can become fuel. Momentum-driven participation often extends moves once key technical and structural levels are breached. However, acceleration is conditional. Persistent backwardation in near months, elevated lease rates, or unusually high delivery participation would serve as confirmation signals of genuine tightness. Absent those confirmations, upside remains a probability scenario tied to sustained stress, not an inevitability. Bear case. The downside scenario begins with liquidity normalization. Weekend premiums often exaggerate stress when participation is thin. As institutional flows return, spreads can compress rapidly. If futures reopen and absorb risk without sustained buying pressure, offshore price prints may retrace toward established benchmarks. Oil is another pivot point. Should geopolitical tension de-escalate or insurance markets recalibrate, crude could surrender a portion of its gains. A retreat in energy prices would ease inflation expectations and reduce urgency in hedging demand for metals. Dollar strength also poses risk. In stress environments, capital frequently migrates toward dollar liquidity. A firm dollar combined with rising nominal yields can pressure precious metals, particularly in leveraged futures positioning. Margin hikes from exchanges, if volatility expands, may force speculative longs to liquidate, accelerating downside moves. Open interest contraction would signal participation exiting rather than accumulating. Physical premiums could normalize if supply routes stabilize and wholesale availability improves. Extreme prints during fragmented trading often overstate structural change. Disciplined investors respect liquidity risk and recognize that balance requires acknowledging compression scenarios alongside expansion. At a recap, compression oil moved roughly 8 to 10% higher. Reported silver premiums widened beyond recent ranges. Open interest remains large relative to registered inventory. First notice day approaches. Near-term volatility expanded. Sovereign gold demand persists. Spread behavior now determines whether pressure resolves through price adjustment or structural tightening. Disciplined close education over emotion. Watch the data. Respect liquidity. Think structurally. Avoid hype. Stay disciplined always.